$300,000 in phantom income hits your 1099C because your life insurance policy lapsed, and the IRS says you owe taxes on money you never received. Most people think when a policy lapses, it just disappears. No tax consequence, right? Wrong. And if you're sitting on a whole life or universal life policy right now, this could cost you 6 figures, so stay with me. IRS Publication 525 and IRC Section 61 say forgiven policy debt is cancellation of debt income. For a household with a $500K whole life policy, $200K in cost basis, and $300K in accumulated loan value, that's $300K in ordinary taxable income recognized in a single year, not capital gains, ordinary income. At 37% federal plus 10, 75% state, California example, plus 3, 8% net investment income tax, the total bill is $127,000 to $150,000 in that year alone. But that's not the worst part. Asterisk, asterisk, here's the cascade most people miss. Asterisk, asterisk, once that phantom income pushes you into a higher bracket, it also triggers Medicare IRS surcharges. If you're already on Medicare, or will be within 2 years, a sudden $300K income spike can push you into the highest IRS tier. That means an additional $3,000 to $8,000 per year in premiums, for life, not temporary. Permanent penalty tied to that 1 year. So a $127K tax hit in year 1 becomes a recurring $5K, $8K annual hit for the rest of your life. That's $100K, $200K more in cumulative costs over a 20-year retirement. Here's what's actually happening. When you stop paying premiums or surrender, the insurance company writes off the outstanding loan balance. That forgiveness is treated as income under IRC Section 61. The IRS Form 1099-C is issued. And if you're in the year you plan to retire or take distributions, this phantom income can push you into a higher tax bracket and demolish years of careful retirement planning. But there are 3 exceptions most people and many tax pros don't know about. Asterisk, asterisk, exception 1, IRC Section 101C surrender timing. Asterisk, asterisk, if the policy is surrendered while the insured is still alive and the cost basis, all premiums paid, exceeds the surrender value, the excess is not taxable income. This is the cleanest exit. The math, if you paid $200K in premiums and the policy is worth $180K, the $20K loss offsets the gain. You owe 0 tax on the lapse. But here's the critical detail. You must surrender before the policy lapses on its own. A lapse is different from a surrender, and it doesn't qualify for this exception. Timing is everything. Asterisk, asterisk, exception 2, IRC Section 108, insolvency relief. Asterisk, asterisk, if your household's total liabilities exceed total assets in the year of lapse, you can elect to exclude cancellation of debt income up to the extent of insolvency. If you're underwater by $150K and the policy forgiveness is $300K, you can exclude $150K. The remaining $150K is still taxable, still a problem, but you've cut the bill roughly in half. That's $60K, $75K in federal and state taxes instead of $127K. Form 982 is filed with your 1040 to claim this. Most people don't even know this form exists. Asterisk, asterisk, exception 3, IRC Section 101, A, death benefit rule. Asterisk, asterisk, if the policy remains in force until death, the full death benefit is excluded from income under Section 101, A1, 0 tax to beneficiaries. The trap, once it lapses, this shield is gone forever. Planning around this means either keeping the policy in force with lower premiums and reduced coverage or surrendering strategically before the lapse occurs. Here's the real-world impact. A pre-retiree, age 58, owns a $500K whole life policy. Cost basis is $200K. Cash surrender value is $250K. Outstanding loan is $280K. If the policy lapses in December of their retirement year, when they also took an $80K IRA distribution, they're now reporting $300K in phantom income plus $80K in distributions equals $380K total income. That crosses into the 37% federal bracket, triggers IRS surcharges on Medicare starting 2 years later, and potentially flags an IRS audit for the sudden income spike. But if they surrendered the policy in November before the lapse and used IRC Section 101C, the $30K difference between cost basis and surrender value is recognized as a loss. Tax bill, 0. Same household, same assets, completely different outcome. Asterisk, asterisk, the action. Asterisk, asterisk, if you own a whole life, universal life, or variable universal life policy you haven't reviewed in 5+ years, pull the latest statement. Calculate 1 cost basis, total premiums paid, 2 current cash surrender value, 3 outstanding policy loans. If cost basis exceeds current value, you have a potential tax trap. If you're within 5 years of retirement. Model 2 scenarios. A. Let it lapse in your lowest income retirement year to mitigate IRMA, or B. Surrender strategically while you still have earned income to offset. Consult a tax professional to run the IRC Section 101C calculation and file Form 982 if Section 108 insolvency applies. The tax code rewards those who study it.